business organizations, shares in corporations. Owners of the corporation hold shares of stock. A share is a fraction of ownership of the corporation. The stock holding is evidenced by the issuing of a share certificate. There may be several classes of stock, each with its own peculiar rights and values. Common stock is usually issued to founders and employees. Preferred stock is usually sold to investors. Since the 1930s, trading in stocks and shares has been highly regulated by the SEC. Shares can only be traded publicly once they've been through a rigorous registration process, often involving an IPO, initial public offering. The shareholders can see significant appreciation in value of their shares if the corporation does well. However, if the corporation is dissolved, shareholders stand in line behind the creditors and usually receive little or nothing from the proceeds of liquidation. Shares that are not properly authorized by the corporation are void and worthless. Share authorization is usually written into the Articles of Incorporation when the company is formed, or through later amendments to the Articles. Amending the Articles and authorizing new shares requires the approval of the shareholders as well as the Board of Directors. Common stock, preferred stock, and different classes of shares can be created, but the different rights associated with each class must be specified and authorized in the Articles. In a corporation wishing to incent staff with stock options, a pool of shares is often created for this purpose, with authorization for management to issue these shares under the supervision of the Board of Directors. The shareholders of a corporation are traditionally expected to pay in cash or some other form of tangible asset for their shares. The benefits of limited liability were provided to shareholders in recognition of their capitalization of the company, and the associated financial risks the shareholder undertook in providing the corporation with finance. This view is still evident in traditional statutes such as that of Delaware. Promissory notes and promises of future services are not valid currencies to buy shares. Such shares are voidable by the company. Services already performed are considered valid forms of payment, but promises to perform services in future are not sufficient under traditional statutes in Delaware and some other states. In states following the Model Act, however, promissory notes and promises of future services are valid currencies to purchase shares, and such shares will not be voidable for lack of consideration. An overall percentage shareholding is important when electing directors, especially in a small corporation. Preemptive rights were created for shareholders wishing to maintain their percentage shareholding in the company by acquiring new shares as and when they are issued. For example, a 20% shareholder would see her holding reduced to 10% as the result of a new share issue that doubles the number of shares. Exercising her preemptive rights would involve the shareholder purchasing 20% of the new shares issued to maintain her overall 20% holding. Preemptive rights are an anti-dilution provision. The shareholder is required to pay to play and purchase new shares if she wishes to maintain her relative position. Newly issued shares cannot be sold to outside investors until existing shareholders have exercised their preemptive rights. In some other countries, preemptive rights are automatically provided to shareholders, but in the US they must be written into Articles of Incorporation. Preemptive rights apply to the same class of stock. A preemptive right for one class does not apply to another class of stock. The purchase of the shares under the preemptive right must usually be in cash. Shareholder investors concerned with the possibility of shares being issued by the Board of Directors at an unfairly low purchase price were traditionally appeased by setting a par value for the shares. Par value is a minimum nominal price below which the shares cannot be sold. shares can be sold by the board at or above par value, but not below. However, the board of directors and officers would be in breach of their fiduciary duties to the corporation if they sold shares below fair market price. So, setting an artificial par value is somewhat unnecessary. The modern trend is to set shares at no par, without a minimum par value. Management then has a duty of care and duty of loyalty to sell the shares at fair market price. In addition to appreciation of share value, another advantage of holding shares is the payment of dividends. Profits not retained by the company can be paid to shareholders as dividends. A dividend is a distribution, normally of cash by the corporation to its shareholders. Deriving from Latin dividendum, the thing to be divided among all, anyone holding stock on the date the dividend is paid receives a pro rata share of the total dividend. Dividends are not mandatory, but are paid at the discretion of the board of directors. Even large wealthy corporations like Microsoft are not obliged to pay dividends. Indeed, Microsoft waited until it had $43 billion in cash before declaring its first dividend in 2003. Although the board of directors cannot be ordered to pay a dividend, it can be prevented from paying the dividend if the company does not have sufficient funds. To protect creditors, each state has restrictions on paying dividends or buying back shares. The idea is to restrict shareholders and the board from stripping the corporation of funds at the expense of creditors. In all states, a dividend is unlawful if it pushes the corporation into insolvency. Before paying a dividend, the board must determine that the company will be able to continue to pay its debts as they fall due, after the monies have been paid by the corporation to the shareholders. Insolvency is an extreme example of a company that's restricted from paying a dividend. But a variety of tests are used to determine if solvent companies are able to pay dividends in the various US states. In some traditional states, dividends can only be paid from surplus or retained earnings. In other states, following a more liberal, modern approach, the test is merely whether assets exceed liabilities. This often turns on whether assets can be reappraised, and revaluation of assets, especially real estate, is allowed as the courts are keen to have the test based on current market values as opposed to imaginary book values. Regardless of the ratio of assets to liabilities, surplus and retained earnings, Delaware corporations are able to declare a nimble dividend that does not exceed the profits made by the corporation in the last 2 years.